Welcome back to Ground Rules. This week we are seeing a tale of two markets. All-season grain prices remain vulnerable, weighed down by large carryover stocks and weaker export competitiveness. At the same time, we've got new season grain prices which continue to find support from the growing threat of El Niño and the higher production risks that come with it. So, is this simply a temporary correction, or are the markets already looking ahead to next season? Let's unpack it. But before we dive in, we are excited to share that Ground Rules has partnered with AMT to bring South Africa's trusted agricultural market intelligence to an even wider audience. While AMT continues delivering its renowned market updates in Afrikaans, Ground Rules is proud to bring you the English edition, drawing on the same trusted AMT data and insights that producers across the country has relied on for years. We see white maize weakening at the start of the week, with the spot price falling to 3,415 Rand per ton, while the July 2027 contract eased to 3,751 Rand per ton. Yellow maize also declined, trading at 3,470 Rand per ton, with July 2027 contract slipping to 3,708 Rand per ton. Soybeans softened as well, with the spot price moving down to 8,000 Rand per ton, while the May 2027 contract is also now trading at 8,041 Rand per ton. Sunflower seed also eased to 10,100 Rand per ton, with May 2027 contract at 9,200 Rand per ton. Elsewhere in the market, sorghum import parity landed in Durban stands at 4,624 Rand per ton. Argentine shelled groundnuts have an export parity price of 21,368 Rand per ton at Randfontein. Cotton remained firm at approximately 11,350 Rand per ton. And as we move over to the fertilizer prices, remember these are international free-on-board FOB prices and do not include shipping, transport, and local handling costs. By the time urea reaches our South African farms, the landed price can be as much as 3,500 Rand per ton higher. Now, nitrogen prices continued climbing last week, with free-on-board Arab Gulf urea now trading at 7,121 Rand per ton. Potassium prices are moving sideways, with free-on-board Brazil KCl at 6,541 Rand per ton, and this market has been less affected by geopolitical tensions. Phosphate prices have eased slightly, with free-on-board Brazil MAP now at 14,573 Rand per ton. Meanwhile, free-on-board China ammonium sulfate has increased to 3,643 Rand per ton. The message is clear. Input costs remain an important consideration as producers prepare for the next planting season. Global markets shift their focus. Grain markets have started the week on the back foot in the global. The biggest reason? The market's attention has shifted almost entirely to the US crop. We've got cooler temperatures and increased rainfall that are being forecast across many of the major production regions in the US, removing much of the weather premium that had previously supported prices. But here's the important point we need to take into consideration. The biggest production risk this year was never necessarily the United States crop. The real concern lies in what could happen later in the year in Brazil as well as in South Africa, particularly if El Niño continues to strengthen as we move towards the end of the year. The question is, how healthy is the US crop? The hotter and the drier weather during July did cause some localized damage to the US maize crop. But at this stage, it doesn't appear severe enough to significantly reduce overall production. July is traditionally the most important weather-sensitive month for US maize. But as we move into August, the market attention naturally shifts towards soybeans. That means maize price volatility may begin to ease as the confidence in the US crop improves. Soybeans, however, could remain much more volatile because August weather then now plays a crucial role in determining the final yields. For now, Weather forecasts remain generally favorable, and as long as that continues, soybean prices may remain under pressure. Back home on South African soil, several factors are also weighing on prices. The South African rand strengthened slightly, and as geopolitical tensions eased, some of the war-related risk premium disappeared from wheat, soybeans, and maize prices towards the end of last week. This was always expected. So old season grain prices have struggled to build sustained upward momentum because of South Africa's large carryover stocks. These abundant local maize supplies continue to limit any short-term price gains. Wheat has also lost some momentum last week, with healthy global supplies and reduced global risks easing any upward pressure. Export competitiveness matters so much. One development that's worth paying more attention to is export competitiveness. By the end of last week, United States and Argentine export parity prices had declined, yet our local suffix prices didn't fall by the same extent. By Friday, South African yellow maize was trading roughly 300 Rand per ton higher above the equivalent of the US export prices. That suggests that there is still room for local prices to decline further if South Africa needs to become more competitive in the export markets. The good news is that we have now exported almost 900,000 tons of maize, making steady progress in reducing the country's large stock levels, even though prices remain too high for large-scale deep-sea exports. Moving over and watching what's happening on the investment side, large investment funds in the United States have continued increasing their net long positions in maize and soybeans while remaining broadly neutral on wheat. That tells us that investors still believe there is upside potential in the grain markets, but it also introduces an additional risk. If the US weather remains favorable, those same investors could quickly reduce their positions, placing then renewed pressure on prices. Old season versus new season grain and marketing strategies. So for producers holding old season grain, the strategy remains unchanged. Take advantage of price rallies whenever opportunities arise, particularly if storage space is limited. We've got large local stocks. We've got weaker export competitiveness, still likely to weigh on nearby prices. Of course, several factors could quickly change that outlook, and these would include a sudden weakening of the rand, renewed geopolitical conflict or higher oil prices, an unexpected downgrade to the US crop, if we've got faster South African export activity, or hotter and drier August weather across the US soybean regions. If any of these developments could happen, it could quickly support prices again. So why does the new season grains look so different? The picture changes dramatically when we look ahead to the next production season. We've got a strengthening El Niño, higher input costs, and the risk of smaller crops in South Africa and South America could mean that the upside price potential remains significant if production really does disappoint. Remember that, once our global stocks levels begin to tighten, even a relatively small reduction in supply can trigger a substantial price rally. That's why producers need to think differently about old season grain and new season grain. Old season prices are largely driven by local stocks, by export competitiveness and the exchange rate, while new season prices will increasingly be driven by production costs, weather risk. So the same marketing strategy does not simply work for both. We will use old season rallies, old season stocks. You use rallies and market grain when opportunities arise. And you will approach new season marketing a bit more cautiously, selling smaller portions as the conditions develop. Production cost into this new season is going to become increasingly important. We've got recent data from FarmBench platform, which now has more than 820 users, which is beginning to provide a valuable picture of production costs across different farming regions. One particularly interesting trend involves soybeans. Okay, the average direct cost for dryland soybeans last season was around 14,350 Rand per hectare. Current planning for the new season is averaging closer to 13,900 Rand per hectare. This doesn't necessarily mean inputs have become cheaper. A more likely explanation is that some producers are planning to reduce expenditure, particularly on fertilizer. However, it is still very much early in the planning season, so it's too soon to draw any firm conclusions. But from that same report, for maize, the trend is moving in the opposite direction. Average direct input costs have increased from around 16,900 Rand per hectare on maize to approximately 18,000 Rand per hectare. And although these figures could also still change before planting begins, we will just watch and see. So, what are the ground rules takeaway for this week? Grain markets are telling two different stories. All-season grain remains under pressure from large local stocks and weaker export competitiveness, making strategic marketing more important than ever. New season, however, is shaping up around a completely different set of risks. We've got higher production costs, we've got the growing likelihood of El Niño, and we've got the potential of smaller crops, which could mean that, the market is already looking beyond today's harvest. For producers, the challenge now isn't simply deciding when to sell, it's understanding which season that you are selling into, because the risks, the opportunities, and the strategies are no longer the same. Thank you so much for watching Ground Rules Grain Market Update this week. And you know how our saying goes, stay informed, stay curious, and remember the best farming decisions always start with some solid ground rules.